Howdy there, folks. Welcome into the three-piece. 3 videos for me to react to in this one here today. First one up here. Carnival just came out with earnings. Going to hear from their CEO on what's going on with travel demand, which is definitely a segment that a lot of people have been wanting to wonder, like, is it slowing down? Is it going to slow down? So we're going to hear directly from him. I think he's a very important person in kind of the travel industry, right? Next video up here, we're going to react to the Fed's favorite inflation indicator rose less than expected in August. So want to hear what's going on there, react to that, kind of give my opinions and perspectives. And the last video up here is a very intriguing one, I gotta say. We are beginning to enter a so-called debt doom loop. Yes, you heard me right, debt doom loop. So definitely looking forward to hearing that one. I appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed. New all-time high subscribers in the history of the channel. We're getting close to 35,000 subscribers. So I appreciate each and every one of you that are always here. Thanks so much for being here, folks. Also, get my Patreon. That's pinned comment down there. I just made 3 moves in there. I just bought 3 stocks. You get to see the stocks I'm buying each and every week. So definitely want to be part of that. That's pinned comment down there. Let's get into this.
Welcome. It's good to have you. I mean, you finally turned a profit, first time since the pandemic, and sounds like you're pretty bullish still on demand. What's happening?
Hey, good morning. Yeah, absolutely. I mean, the one word we could use to describe our third quarter was record. We hit record revenues, record customer deposits, record booking levels for the future. So all signs are incredibly positive.
Records, and the stock's at a record low. Okay, maybe it's not quite at a record low, but it's certainly not at a record high, okay? Intriguing, wow, okay, record, future bookings too, that's huge. Everybody always wants, well, is the future going to be okay, right? That's a big statement.
And we're, of course, bullish.
So what about that outlook, which was disappointing? I know fuel costs have been on the rise. Is that it, or is there something else happening here?
Well, I mean, I can tell you what we delivered, which was that record position for our third quarter. I can also tell you for the fourth quarter, we're projecting continued strength in revenue. Our per diems are going to be up 7% again, which is consistent with the first quarter and the second quarter, and effectively the third quarter. So we're doing the job. We're delivering the performance that we said we would deliver, despite the spike in fuel, absolutely, which is a big piece of our cost structure. But despite that spike, what we said is we're going to raise our guidance for the year. So we feel very, very good, and the consumer has shown absolutely no signs of slowing down with our business.
I gotta say, guys, okay, oh boy, are we about to talk about Carnival Cruise Line? Oh boy. Whew. Okay, first off, do you know my history in regards to Carnival? Okay, I'll tell you my history in regards to Carnival. I really started looking into and investing into Carnival kind of toward the end of 2019. And I saw a company that had a very stable business model, that even in a recessionary scenario, they were still going to make profits. And I really liked the company. And so I started investing in it. And what happens right after that, sometimes in the financial markets, you're going to have really good luck. Sometimes you're going to have very, very bad luck. Same thing with life, right? Sometimes, if you're objective about your life, sometimes you look back and like, damn, I had really good luck in that situation. Sometimes you're going to look back and be like, damn, I had pretty bad luck. That was, not good fortune there, right? Well, once in a 100-year pandemic hit, Rona, right? And it devastated the cruise operators. It devastated, obviously, all travel companies, but the cruise operators got hit the hardest of anything in the world. There was nothing that got hit harder than cruise operators. Even restaurants and hotels had it better than cruise operators. They had it the worst. And so it was devastating their business models. Obviously, Carnival had to take out a lot of debt. They had to do a ton of share issuances and raise money and all those sorts of things. It was a horrible situation, right? And I ended up selling that stock for probably, I don't even remember. It might have been a $20,000 or $30,000 loss. It was bad. And so that's my history with Carnival. But I gotta say, this is a kind of a little bit of an intriguing story here. Unless there's another once in a 100-year pandemic we have, this business model is actually a great profitable business model over the long term, regardless of fuel costs going up, down, all around. Like if you look at like Carnival prior to Rona, this is a company that always puts up great numbers. And so they're back to profitability now. I don't know, man. At $13 a share, this is a stock I can actually hold during a recession. The only time you can't hold Carnival is during a once in a 100-year pandemic. That's it. Outside of that, it's actually, a decent stock. Of course, it gets hit with the market. If the market goes down a bunch, like every other stock in the market, but that's not a reason to not hold the stock, right? So, there might be something here with Carnival.
No signs in terms of forward bookings all the way into 24 and spending patterns on board? You're not really seeing a change?
We're really not. What we said on our call earlier today is when you look at the onboard spend levels of our consumers, it's been consistent every single quarter, and we're forecasting the same for the fourth quarter. So there's been no slowdown in that immediate sense of gratification that we can get from the onboard spend levels. Our yields were a record high in the third quarter. We're booked 10 points higher than we have ever been booked in our history at higher prices. So all signs for us are no slowdown.
Josh, you can't blame an investor or a viewer from wondering what the difference is between your outlook and those of the major airlines, where they have guided lower. They've talked about softer close-in leisure bookings in September. They've talked about oil. They've talked about weather.
Before he gets into him versus airlines, the beautiful thing about Carnival Cruise Line business model that I think everybody needs to understand, because this was a company I was investing in and just happened to invest in it at the worst time in human history. But everybody needs to understand this, okay? Carnival Cruise Line benefits from even like people that are trading down, because their cruises are very affordable, extremely affordable. One of the most affordable kind of travel, trips you could possibly do. And so when it comes to Carnival Cruise Line, even if people are tighter on money, let's say, and they can't go on as extravagant getting on a trip as they might have went a year ago. So let's say in 2024, let's say the consumer's in a worse place, which is not even a for sure thing. That could be wrong. The consumer could actually be in a better place in 24. But let's assume they're in a worse place. Carnival's, people still go on vacations. And Carnival's so dang affordable compared to all your other vacation options out there. It's ridiculous. There's nothing more affordable, honestly, that I can see that's a decent vacation than Carnival. I went on one of those cruises before, and I could tell you it's freaking cheap. And I can tell you I've been on a lot of other vacations, not cheap at all, okay? So that's another thing. They benefit from a trade down. That's why it's one of those stocks, even in a recessionary scenario, you can actually feel comfortable. The only time you can't, once again, is during a once in a 100-year pandemic.
Why is that not a factor for cruise lines?
Well, as you probably heard me say before, we are an unprecedented and unwarranted value gap to other alternatives, anywhere from 25 or 50%. And in this type of environment, that is a fantastic wind at our backs. Why? Because the consumer knows they'll get great value from us. And if they're looking to get more for their vacation dollar, they can take a cruise and have an amazing experience without having to worry about anything. And that's exactly what cruising provides.
What are you seeing in Europe? You obviously have a lot of exposure there. You had talked about last quarter improvement. Is that continuing? Because some of the macro data in Europe specifically has really weakened. And Jane Fraser of Citi this morning was talking about that too.
Yeah, I'm happy to say the strength that we've shown in our results and in the forward projections are in large part due to the strength of the recovery of our European brands. Our two continental European brands this summer, AIDA and Costa, both had higher yields in the third quarter of 2023 than they did in 2019. And that's a far cry from a year ago when I was talking about the concerns that we had about Europe because of energy concerns, the Ukraine geopolitical state of the consumer. The fact is, Europe is now helping drive our results even further, and I couldn't be prouder of the teams.
Europe's been shocking, folks, okay? So I know most of my viewers are the United States, probably, I would say 60% of the people that are watching this video right now, you live in the United States, right? A good portion of you probably live in Canada. Shout out to the Canadians. A decent portion of you guys live in Europe, right? And then kind of rest of the world. And Europe's been hit just as hard, if not harder than just about anybody in regards to inflation, right? But there's something fascinating going on in Europe right now. And you see this in not just what the Carnival CEO said right there, but did you see that earnings that came out last night? The earnings by Nike. Europe is a strong market for Nike right now. Look at their footwear sales. If I recall off the top of my head, footwear was up, I believe, 10% in Europe. It was a very strong number out of the European market. It doesn't make any sense when you factor in the fact that Europe's been hit harder than just about anybody in regards to inflation. It got hit much harder than actually the United States. But that's what we have going on. So we're in fascinating times, folks. Fascinating times where sometimes you think, oh, this has to be this way or that way, and it's just not that way. Alrighty, next one up here. The Fed's favorite inflation indicator rose less than expected in August.
Personal income and spending report that does include the core PCE data that we're waiting for too. Dow right now up by 161 points above fair value. Rick Santelli is standing by at the CME in Chicago. Rick, the numbers, please.
Yes, personal income and spending for the month of August starting to populate here, and the income numbers expected up 0.4%. Well, it's exactly up 0.4%. And if to find a higher month-over-month change, you'd have to go back to January when it was up 0.7, although we had several 0.4 earlier in the year. If you look at spending alone, it is also up 0.4, and 0.4 is actually the lowest number since May of this year because it's following 0.6 and 0.8 higher. Now, if we look at real spending, that's up 0.1, so we could see inflation does take a bite out of that. Now, let's get into the deflator. The deflators are always important. Now, here's the month over month. It's up 0.4. That's a little cool to expectations, but if you compare it to history, up 0.4 is the highest level since January, which means it's the second, of course, highest of the year. Year-over-year numbers may be the most important aspect here. And keep in mind, the year-over-year deflator peaked in June of last year at 7%, expected up 3.5%, exactly as it is, up 3.5%, with an upward revision the last month from 3.3 to 3.4. Now, on the 3.5 front, that is the lowest, well, just since obviously last month, but it actually now becomes the highest since May when it was at 3.8. Not something I want to say. We don't like to see these things moving in the upper direction. Now, if we look at the deflator, personal consumption deflator, core month over month, expected up 0.2, it arrives at up 0.1, 0.1,
okay.
and 0.1 follows an up 0.2.
Okay.
And now, in my opinion, the most important number of all, the personal consumption expenditure core deflator year over year, and it finally breaks the 4%, 3.9. As expected, following 4.2, that moves to 4.3. And why am I so?
All those numbers you just heard listed off there, those last two were the most important ones, in my personal opinion. Those last two were the most important. That's good.
Excited about this particular number. Well, consider this. It hadn't been below 4% since SEP of 21. Okay, last year alone, half the readings were above 5%. So it indeed is progress. But progress is slow. 3.9 is a long way from 2%. And to hear so many Fed officials seem to be so pleased at the performance of the drop in inflation, which I agree with, but these are still sticky numbers. Real quickly, let's take care of something else. Trade balance moved lower to minus 84.3 billion. We're expecting a number over 91. Wholesale inventories down 0.1%. Retail inventories actually up double expectations at 1.1. Interest rates are highly unchanged, but do keep in mind, I think...
I don't really look at the numbers as being like so sticky. The bottom line is, man, we're coming off of CPIs that were, 9% last year? The core numbers were ridiculous last year. The PPI numbers, everything was ridiculous last year. So we're still on the, come down from that. So I just think it's a wrong perspective to look at and say, it's sticky or not sticky. In 2024, you'll find out really if things are really that sticky or not. We're just on the come down of ridiculous numbers we faced last year.
Yesterday, we put an interim peak in treasuries. We'll have to wait and see. Becky, back to you.
You don't go from 9
Hey,
to
Rick,
2.
Core PCE, that is good to be back
Takes
below
time.
4% year over year, 3.9%. Core does not include energy. Energy prices have gotten a lot higher recently, and that's fine. You want to take out some of the volatility, but core energy prices eventually bleed through to a lot of other areas that would show up in the core, right?
I couldn't agree more. It is exciting to see we drop below 4%, but it's still on the high side, and you're correct. Most Americans right now, they don't agree with looking at things from a core perspective because at their core, and what bugs them the most, food and energy prices being very high. And even if these numbers moderate, and we've talked about this many times, it doesn't mean we're going back to where prices were pre-COVID.
Rick, thank you. Right now, Steve Leisman joins us. He has more on these numbers. Steve, what really jumps out at you?
Well, first of all, I want to go back to the question you asked, Rick, because I was talking to one of those, millennial types the other day, and the person was saying, hey, the government inflation numbers are no good because they take out energy. That's not right. The government reports two different sets of numbers. One is a headline number that includes energy and food. One is a core number that takes it out. You can look at whatever you want. I think you know this, Becky. Apparently not everybody does. I want to make sure people understand that.
Oh, no, Steve, my bigger point was that even if you are focused on core like the Fed is, and I understand the reasons for that because you want the volatility out, the energy prices eventually feed back down the line into all kinds of stuff that isn't CPI.
Exactly. I think that's what Rick Santelli missed there, right? I mean, at the end of the day, if gas prices are much more expensive, guess what that means? It means a lot more than just what you pay at the pump if you drive an internal combustion engine car, right, is a problem. No, it's also other problems, right? All the stuff that gets transported around, guess what? Prices are going to have to be jacked up for that. If you're talking about a case of water, you're talking about transporting tomatoes around and steak around and all this stuff. Well, guess what? Somebody's gonna get hit with the cost of that if the pricing for transportation goes up immensely, right? So that's just kind of some food for thought there. If Uber, it might be a little more expensive if gas prices are higher in that sort of environment, right? You could just run through all the different real world examples. The airlines might need to charge a little more if fuel is more expensive, right? The cruise operator might need to charge a little more. Like it has ramifications way past just I go to gas my car up at the gas pump and it's a higher number.
Whether that be delivery costs for things, it winds up in manufacturing, winds up everywhere. So higher energy prices, if they last, if they're not volatile, they do show up in the CPI.
That's exactly what I was going to say. I just wanted to make clear that there's not a great conspiracy going on to not report the higher energy prices. But you're right, Becky. That's why what I'm going to say about these numbers here is so far so good, but it's a little hard to take it too far because what you have is you have the spike in energy prices, which you see in the rising headline number. The Fed is going to look through that to an extent until it becomes concerned that what's happening in the energy prices are feeding into the core. And that kind of gets us to why. Why do we look at the core? We look at the core because it's perhaps a better way to make policy over a longer term and to not go up and down with energy prices and food prices, which tend to be more volatile. And by the way, there are many other things published by different Federal Reserve banks that look at other volatile things and maybe takes those out, the trim mean things, other ways to look at inflation, all published by either the government or quasi-government agencies. Just want to make sure there's no conspiracy there. So what's happening is what I saw this morning, as soon as that number came out, is a little bit of lower probabilities on the outlook for the Federal Reserve this year, and I want to just give you the freshest quotes we got here. What I'm looking now is about a 32% probability for another quarter point. We'll call it 34 probability for December, another quarter point. And then looking to the cuts, 42% in June. What's happened essentially, Becky, is that the probability of a rate cut has moved more to June, July, and obviously the total amount of cuts baked in by the Fed and therefore by the market have come down for next year.
Yeah, and from the market perspective, from the stock market perspective, right, the fact that potential, and these are potential rate cuts, are being moved out further and further and further, okay? What I will say for the stock market and why this matters quite a bit for the stock market is I would say the fact that these are being moved out so much is actually, surprisingly enough, folks, it's actually good news for the stock market. And the reason being is now everybody's kind of, a lot of people aren't even planning on rate cuts for 24 now at this point in time. And if they are, they're expecting like late 2024 rate cuts. So that puts like no more like belief that, we're going to get rate cuts in the first half or even the middle of 2024. Most people have kind of thrown that out the door now at this point in time, right? So if for any reason we do get rate cuts sooner than expected, then that could potentially be kind of a bullish sign as long as the economy hasn't fallen apart or something like that and things are holding together well. So versus everybody's expecting it, it doesn't come, rates are still high and everybody's like, what the heck's going on? So if anything, I would look at that as kind of a little more bullish than bearish, okay? Alrighty, last video up here to react to out of this three-piece is we are beginning to enter a so-called debt doom loop. This is the one I'm looking really forward to, debt doom loop. Interesting. On
Sunday, and Congress still has no deal. For a closer look at the economic implications of a government shutdown, we want to bring in Romina Baccia. She is a Cato Institute Director and Budget of Entitlement Policy. Also, Michael Linden, who is former OMB Executive Associate Director in the Biden administration. He's now a senior policy fellow with the Washington Center for Equitable Growth. Michael, why don't we start with you, because you were actually in the room just a few months ago when you were still at the OMB when they were doing these negotiations for the debt ceiling. That worked out. We had a deal. What do you think of what you see at this point?
You know, it's a good question, and thanks so much for having me this morning. You know, as you said, I was in the room a few months ago when we were negotiating the debt limit deal, and at that time, we were all agreed that part of the purpose of that deal was to make it so that the appropriations process could proceed normally and we would avoid a government shutdown. I think we all want to avoid a shutdown. Shutdowns are bad. I think we can all agree about that. And the challenge that we have right now is that one faction in one chamber in one party is trying to hijack that process. And unfortunately, the speaker is allowing that. The solution is pretty simple, though. That's the good news, is there's a bipartisan majority in both chambers, frankly, to keep the government open. They just need to put that to a simple vote, and we can, put this behind us, and Congress can get to work executing that deal that everybody agreed to just a few months ago.
Speaker McCarthy has expressed quite a bit of frustration himself. I heard some more comments that he made last night going through with some of this. Look, the issue is that if he brings that vote to the floor, they're going to try and oust him. That's at this point, some of those 5 to 10 members are really trying to get pushy with this. How?
I heard it was 4 people. I don't know for sure, okay, but I heard Marjorie Taylor Greene. I heard DeSantis, so I don't know. I don't know who's really holding up the process, but those are some of the names that I heard.
How do you deal with that? And by the way, if they are successful in ousting him, you are then dealing with a speaker who has even less power probably than McCarthy, because he's completely beholden to that group of people.
I think there are people better qualified than me to talk about the internal politics of the House Republican caucus. I will just say that the speaker successfully convinced 150 of his members to vote for the Fiscal Responsibility Act. Some of these same members of his that are threatening to shut down the government were not happy with that deal. They're still not happy with that deal, but they didn't vote to oust him after that deal. And I think the speaker should put the American people's interests first above the interests of a few small minority of his own members, and keep the government open, or else there will be consequences for ordinary people, for the economy, for the budget. And I think that the speaker knows that. I think he's trying to wait until the very last minute, but hopefully he'll come to his senses and put a clean CR to vote.
Romina, what are the consequences of the government shutdown at this point? It's not the same as a debt default, which has a much bigger implication if you're not paying off treasuries and beyond. But what are the implications of a government shutdown?
It all depends on the length of the government shutdown, because the longer it goes on, the more severe the economic implications likely will be. I think that a short-lived government shutdown will cause a blip in the economy. We also saw in earlier shutdowns back in 2019, that one was a smaller partial shutdown, but the economy continued to roar because this was after the tax cuts and we had very low unemployment just before the pandemic. It won't be a huge factor. I would like to disagree with Michael and say I place blame on both sides. I have not yet seen a clean CR that honors the fiscal commitments made in the debt limit deal, not from the House and not from the Senate. Everything I've seen is full of emergency spending, other gimmicks, and additional supplemental funding that was not agreed to in the debt limit deal. So I just want to say that I wouldn't place all this blame on the Republican side. They do have some legitimate grievances here.
We were just talking.
And I agree with that. There's always 2 sides to the story. There's always 2 sides to the story, and that's why it's always important to look at both sides. A lot of people only focused on their side, and that's it, and they don't want to even hear what's going on from the other side, and they just look at it one angle. I think it's important to just broaden out a little bit, especially if you're somebody in the financial markets and you care about, your money and in the stock market and your wealth and those sorts of things. It's more important, I can just say, to look objectively at these things and just understand it's usually not just one side's a problem. It's usually both sides are doing something a little strange.
With someone about the bond picture and what's going to happen to interest rates from here, what's going to happen with the issuance that the United States has to continue with those treasuries. going to get a lot more expensive if there aren't buyers who are willing to step up. Romina, what do you think just about the situation we're in and where interest rates might head?
Yeah, I think the much bigger issue is not this likely temporary government shutdown, but the fact that the U.S. government is borrowing increasing amounts of money as interest rates are rising. We are beginning to enter a so-called debt doom loop where government borrowing drives up interest rates, and trying to pay those that interest continues to contribute to higher interest rates. And what we're seeing in Washington is political dysfunction, not just to deal with funding the government, but to address the much bigger issues that are driving us down this debt crisis, which are unsustainable spending on major healthcare and pension entitlements, Social Security and Medicare in particular here, which are responsible for 95% of unfunded obligation. And I think there, the Speaker McCarthy has his pulse on the issue by saying what we need is a fiscal commission. Congress needs help here. These issues are bigger than our current governing institutions.
Boom, she brings up great points there. Freaking phenomenal points, okay? And this is a huge problem. This is a huge problem because government spending obviously so much, as she spoke about there, and you can look into the numbers if you want to look deeper, right? And you should not be spending like insane when you have very low unemployment. Bottom line is, you want to ramp up your spending when you're in a recessionary scenario, when the people need help and those sorts of things. When you're at very low unemployment numbers, you shouldn't be spending like crazy because that creates potentially more inflation in the system, which creates higher interest rates, which then you have to pay on those higher interest rates in terms of the people and in terms of the government. It's a whole messed up situation. And so, man, if I was like, as soon as we started getting out of Rona, which was, at the end of 21, we should have cut down massively on spending into 22, 23, and kind of been watching spending for these few years here, knowing that you're going into a higher inflationary environment, knowing that you're at rather low unemployment rates. Man, but they just didn't do that. And so now it's creating a bigger problem for the Fed to deal with. It's creating a bigger problem for people to deal with. And then what do we do when we actually have a recession? Like, are we going to have the spending then? Or is it going to be tough times? That's,
Actually, with how polarized they are, can handle by themselves.
Michael?
I think that to the extent that there are fiscal concerns, a government shutdown will exacerbate those concerns, not ameliorate them. It's exactly the wrong thing to do. But if you want to step back, I think we can all agree that there are fiscal risks associated with the current trajectory that the budget's on. They're not as big as my colleague just mentioned. There's a debate about how serious they are, but there are risks. And if you look back and say, why do we have larger deficits and debt today than we expected 20 or 30 years ago? The answer is actually entirely because of repeated tax cuts in the last 20 years, those that were mainly skewed to the wealthy and corporations. So if Republicans in the House were actually concerned about that, they would not be pushing for more tax cuts for the wealthy and corporations, and they would not be focusing their attention cutting things like education funding or clean drinking water funding. These are proposals that they actually have in their appropriations bills. And if they want to talk about, how to fund the government with an appropriate tax system that meets the needs of the kinds of obligations that the American people have repeatedly demanded of their government, things like Social Security and Medicare, those are bedrock principles that the American people support. And we need a tax system that would support that. But that's not what this conversation is about. That's not what a government shutdown is about. And the simple fact is that there's no need for a government shutdown here, and it wouldn't help in any respect.
Yeah, I pay a whole lot in taxes. I don't know about you guys. Do you feel like you've gotten all these tax cuts that supposedly have gone through over the last few decades? Because I'm not quite feeling it. I can tell you that much. Let me know if you're happy with the amount of you paying taxes. I would love to hear from you guys, okay? Appreciate everybody joining me as always. I think we'd all rather pay less in taxes. I think that's a pretty universal thing. So appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed. Appreciate each and every one of you. Make sure you get my Patreon. That is the pinned comment down there. You get to see the stocks I bought today, which I bought 3 stocks here today, and also in future weeks as well. Much love and have a great day.